As of 10:50 a.m. Central Time, SoundHound AI, trading under the ticker SOUN, is priced at $16.52, reflecting an intraday gain of about 1.69%. The stock has been active, trading in a range between $15.55 and $16.55 on a volume that has already surpassed 29 million shares. This immediate price action might seem like just another volatile day for a popular AI name, but it belies a much deeper and more complex reality. The common perception is that SoundHound is riding the coattails of the broader AI frenzy, a high-risk, high-reward play fueled by hype. But the reality is that the company is making calculated, aggressive moves to transition from a speculative growth story into an indispensable enterprise solution, and the market is struggling to decide whether to price it on its current losses or its monumental future potential. Let's ground ourselves in the immediate present. The stock's movement today isn't happening in a vacuum. It follows a period of significant volatility. Over the past year, investors have seen a meteoric rise of over 230%, yet 2025 itself has presented a more sobering picture with a notable decline. This tug of war is the perfect illustration of the central tension surrounding SoundHound. The expectation is that of a speculative tech stock heavily influenced by retail sentiment and prone to wild swings, perhaps a stock you trade on a platform like Robinhood hoping to catch a wave. The reality, however, is that institutional ownership is significant, sitting at nearly 43%, with major players like Vanguard and BlackRock holding substantial positions. This isn't just a meme stock, it's a company attracting serious capital from entities that often have a much longer investment horizon, suggesting they see a durable business model taking shape beneath the surface-level volatility. An individual brokerage account with a provider like Fidelity or SoFi Invest would show you the raw price action, but the story is in the ownership data and the strategic shifts underway. The most recent financial reports are where this tension between expectation and reality becomes starkly visible. For the second quarter of 2025, SoundHound reported a staggering 217% year-over-year increase in revenue, posting $42.6 million. This led management to raise its full-year revenue guidance to a range of $160 million to $178 million, nearly doubling the previous year's performance. This is the kind of explosive top-line growth that gets investors excited. The expectation is that this growth will continue unabated. But the reality is that profitability remains elusive and is a major point of concern. The company posted a GAAP loss of $74.7 million in the same quarter, and its net profit margin is deeply negative. While bulls will point to the company's guidance for adjusted EBITDA profitability by the end of the year and its strong cash position of over $230 million with no debt, the bears will highlight the massive operating expenses and the long road to sustainable net income. This dichotomy is why analyst ratings are so mixed, with a consensus moderate buy, but with price targets that suggest only minimal upside from current levels. Some see a future AI titan, while others see a cash-burning machine with a valuation that has gotten ahead of itself. So, what does SoundHound actually do? At its core, it is a leader in voice artificial intelligence and conversational AI. The company's mission is to allow people to interact with technology naturally through speech. It started with the popular music recognition app, but has evolved into a powerful B2B platform. Its proprietary technologies like speech-to-meaning and deep meaning understanding are designed to go beyond simple command recognition, aiming to comprehend intent and context. This is what separates it from more basic voice assistants. The business model primarily revolves around licensing this advanced technology. Its biggest inroads have been in the automotive sector, with partnerships with major brands like Hyundai, Mercedes-Benz, and Stellantis to create sophisticated in-car voice assistants. Another massive and rapidly growing vertical is the restaurant industry, where SoundHound's AI is being used for voice-enabled drive-thrus and phone ordering, partnering with chains like White Castle and Jersey Mike's. The strategic acquisition of Sync3 and more recently Amelia has dramatically expanded its footprint in the enterprise AI market, giving it access to hundreds of new corporate clients across various sectors. This is where self-investing individuals using platforms like Interactive Brokers or Schwab Intelligent Portfolios need to look beyond the consumer-facing app and understand the deep B2B integration that forms the true backbone of the company's strategy. The recent stock performance is directly tied to these strategic moves. The acquisition of Interactions, an AI voice assistant provider, was a significant catalyst, prompting analysts at firms like D.A. Davidson and Wedbush to reiterate positive ratings. The launch of Vision AI, which aims to combine visual data with conversational AI, opens up another frontier of applications, from retail to automotive. These developments feed the narrative of a company that is not just participating in the AI boom, but is actively shaping its application in the real world. Trading volumes often spike on such news as the market digests the long-term implications. The reality is that SoundHound is aggressively pursuing market share and technological leadership, even at the cost of short-term profitability. Management's forecast of 50% organic revenue growth for the foreseeable future is ambitious, but it reflects a confidence born from a multi-year backlog of business that reportedly exceeds $1 billion. Comment below on whether you believe SoundHound's aggressive acquisition strategy is a smart move for long-term growth or a risky bet that could strain its financials. Looking ahead, the future outlook is a landscape of immense opportunity fraught with significant risk. The primary catalyst is the continued adoption of conversational AI across industries. The total addressable market is enormous, spanning customer service, healthcare, hospitality, and beyond. SoundHound's established partnerships and growing ecosystem provide a strong foundation. If it can successfully integrate its recent acquisitions and demonstrate a clear path to profitability, the stock could see substantial appreciation. The expectation of many retail investors is for another parabolic move like the one seen in 2024. The reality is likely to be a more measured, albeit potentially volatile climb that is heavily dependent on execution. The key risks cannot be ignored. The most significant is competition. While SoundHound has a technological edge, it operates in a space with giants like Google, Amazon, and Apple, all of whom have deep pockets and extensive AI research divisions. Furthermore, the company's current unprofitability makes it vulnerable to shifts in market sentiment, especially if broader economic conditions sour and investors become less tolerant of companies without a clear line of sight to positive earnings. The projected slowdown in revenue growth for 2026 from nearly 100% in 2025 to a forecasted 29% is another point of concern that could temper investor enthusiasm. In summary, the story of SoundHound AI is a classic battle between a compelling, high-growth narrative and the harsh realities of its current financial statements. The expectation is that of a pure-play AI stock destined to soar. The reality is a company in a critical transitional phase, leveraging impressive technological capabilities and strategic acquisitions to build a durable enterprise business. The path forward is not without its perils, including intense competition and the persistent challenge of achieving profitability. The intraday price of $16.52 is but a single frame in a much longer and more dramatic film. The ultimate trajectory of the stock will depend not on hype, but on whether the company can convert its technological prowess and expanding market presence into a sustainable, profitable enterprise. The evidence suggests the foundation is being laid, but the market remains, for now, cautiously optimistic, waiting for the reality of profits to catch up with the expectation of dominance.